Joining us today. Today we're going to talk about title insurance and the title insurance process, particularly through the looking at documents. So explaining that process by looking at particular documents. So as always, I'm going to share my screen. Let me know if you can see my presentation. Are we seeing that?
Yes.
Okay, very good. So here's our agenda today. We're going to talk about these documents: preliminary opinion, title commitment, the endorsements to the policy itself, including what's called the jacket, and then this curious thing called the closing protection letter. So we're going to start with the preliminary title opinion. And I want to say at the beginning that a lot of these terms that I'm going to be talking about today are very literal. So when I say a title opinion, it's exactly that. It's an opinion that an attorney is making about the status of the title. So first thing, in North Carolina, the preliminary title opinion must be done by a North Carolina licensed attorney. And that attorney must be independent of the title insurance company that's going to issue the policy, right? That's a statute. And that is very different from the way that it's done in a lot of other states. In most states, although not all, there is only one company that is handling the transaction. They do the title search, they do the closing, and they issue the title products. In North Carolina, we have this bifurcated system where we have attorneys who are doing the closings, who are doing the title opinions, and then there's us, which are issuing the title insurance. And the two are not supposed to mix, right? So it's a very different process in North Carolina, and it tends to make us a bit of an oddball. Now, when an attorney renders a title opinion, what he or she is doing is telling us what they found on the public records. So they're looking at particular public records, typically at the Register of Deeds and the Clerk of Court's office. And they're telling us what those documents say. And they have to do that for a particular period of time. So they have to search the public records going back a particular period of time. And what that period of time is, they're mostly taking cues from us. So we're telling them as the insurers, this is what our expectations are of you as far as the search period. And we've decided as an industry that 30 years is the sort of the default setting, that unless there's an acceptable shortcut, which we'll talk about in a second, the title attorney must look at the public records for a period of 30 years. So from today, going back 30 years. Now, why 30 years? That's a good question. Like most of the things that we do in title insurance, it's simply a risk assessment. So many of the things that we do and we allow and that are industry standards are simply a amalgamation, an accumulation of data over the years that gives us a sense of what the risk is. In North Carolina, we have this thing called the Marketable Title Act. And very, very briefly, what the Marketable Title Act says is that if there is a title defect that's older than 30 years, that we can ignore it. Now, it's more complicated than that, but basically that's what it says. And so it may be that when we settled on 30 years as our assessment of proper risk, part of that assessment may have been the fact that we have this thing called the Marketable Title Act, which may offer us some relief for title defects that are older than 30 years. So the standard, the default setting is a 30-year search, but we have some shortcuts that we allow in our industry. And those shortcuts are, again, based on assessments of risk. So the two main shortcuts are developer searches and tacking to prior policies. So let's talk about developer searches. A developer search is searching the public records back from today until you find a developer, someone who has developed that property. And so if that developer is 5 years ago, 10 years ago, 20 years ago, but whatever it is, you can stop at that developer and then come forward. So it's a shortcut over the 30 years because there was a developer in the chain. And so why is that important? Why do we allow a shortcut because there's a developer? The understanding, the assumption is that if somebody's going to spend millions of dollars to buy a piece of land, that they're going to scrub the title, that they're hire a lawyer who they're going to pay a lot of money to make sure that there are no issues, because a lot is riding on the title to that property, because they're going to take that piece of property and maybe spin off 20, 30, 50 units, maybe more. And so the title has to be pristine. And so from a risk standpoint, as an industry, we have just come to realize that as long as there's a developer in the chain, we don't need to go behind that developer because we're not likely to find something that enhances the risk profile. The second shortcut is tacking to prior policies. I'm going to talk about that a little bit more on the next slide. And then one final shortcut is related to refinances. So in a refinance transaction, we're only going to ask for a current owner search, right? So that means that the day that the current owner acquired the property forward, that's the only thing that we're going to worry about searching. Why is that? Because we're only going to be issuing a lender's policy. Right? We will not be issuing an owner's policy in a refinance transaction. And what we've learned over however many years, hundreds or more, with title insurance is that typically lenders don't file claims. Owners file claims, lenders don't typically file claims. And since we're only issuing a lender's policy, it's reduced risk, and we're willing to allow for a shortened period of time on that title search. So I mentioned tacking, right? So tacking to a prior policy, and you all are in sales. Kathy used to be a paralegal, so you know how important the policy, finding the current policy is. But this is the reason why it's important. It allows the attorney to do a shortened search. So they find whatever policy they can that's in the chain. Hopefully it's the policy of the current owner. And we will allow them to start on the date of that policy and come forward on their title search. So it really helps them out because it's reducing the amount of time that they're going to spend doing the title search. And the reason why we're willing to do that is, again, because it is a limited risk. In our case, it's a limited risk because there is another title carrier who is assuming the liability for their period of time in which they're insuring. So let me give you an example. If First American issued a policy on the first day of January 2020, then that means that any title defects that are found in the chain of title, any claims that come up for title defects related to that period of time are going to fall on First American. So if a claim is filed today, we've insured the property because we tacked to a First American policy, but the title defect is something that occurred in 1970 or 1980, then what we will do is we'll pay the claim and then seek reimbursement from First American. And the reason why we can seek reimbursement from First American is that all of the carriers in the state have agreed to that. They've all signed a memorandum that says, if there is a claim on our period of time in which we've insured, then we will accept liability. So we're all allowing each other to tack to our policies, and we're agreeing to indemnify or pay them back if something happens within that period of time in which we were insuring. Now, because it's limited, it's less risk, we are also willing to give a discount. So whenever there's a prior policy, there's a discounted rate for the new buyer. So these policies are very important to attorneys for two reasons. One, it's less work. If they can find the policy, they don't have to search the public records for as long of a length of time. And two, it gives their clients a discount. Right? So that's why those things are important to our customers. And because they're important to our customers, they're important to us. which is why we offer those services to our customers to find those prior policies. So let's look at a commitment. So let me go back here, stop sharing my screen, and then share my screen again and show you an example of what I'm talking about. Can everybody see that now? Christine, can you see that? Okay.
Yeah.
So that is an example of a commitment. I'm sorry, excuse me, of a preliminary opinion on title. This one happens to be on barrister's title letterhead, but it's virtually the same between the words on this form and the North Carolina standard bar form of an opinion on title.
Everybody basically takes the standard form and puts their logo at the top, right?
Yeah, pretty much.
Yeah.
And if you produce this document in SoftPro, it's going to look the same. It's just not going to have the logo at the top. So the first thing this is doing, number one here, is that the attorney is telling us that he or she examined the record title in the particular county where the property is located. They're also going to tell us how the property is described. And they're going to tell us some exceptions on the title, and I'm going to explain what exceptions are in just a sec. But they're going to give us some data, like what is the status of the taxes? Are they due? Are they not due? Are they delinquent? They're going to tell us things that are impacting the property, like the fact that there are restrictive covenants, or that there may be a plat that describes the property. They're going to tell us some other things about the property, like anything that's weird that they found, or if they found any liens, like a judgment lien or a claim of lien or a deed of trust, which is a mortgage. They're going to tell us about all the things that they have found that have impacted this property. And they're going to tell us the search period, right? So that search period needs to be 30 years or more, or there needs to be an acceptable shortcut. So if it's a developer search, oftentimes they'll write the word developer where it says the search period was from. If they're tacking to a policy, then they'll put the date of the policy there. Now, this document is also what we in the sales world call an order. So when we get an order, what we're really getting is this title opinion from an attorney, which also is an application for title insurance. So you can see on my screen here, they're going to complete this. They're going to tell us who the owner is, who the buyer is, how much they're paying for it, who that buyer's lender is, the loan amount, and that's just giving us some data about the transaction. So when they send over this title opinion, they're also telling us that they want us to work with them. Okay, so I'm going to go back to my slides. All right, so back to the slides. So when we get that title policy, or excuse me, that title opinion, we do something in response. And what we do is we issue a commitment. And you see here from this slide, a commitment is an act, right? In our case, it's an act and it's also a document. And as I said earlier, very literal terms in our industry, a commitment is what it sounds like. It is a commitment to insure. That we are telling the attorney when we issue this document that we are committed to issuing a policy provided that they meet certain requirements. We also call this a binder, and it's the same idea that we are bound to issue a policy provided that they do certain things, which I'm going to explain. And that commitment is broken up into three parts. Right? It's got a Schedule A, a Schedule B, and a Schedule C. So let's look at what's in Schedule A. Schedule A is basic information detailing the transaction, right? It tells us who the owner is, who the buyer is, who the buyer's lender is, what the purchase price is, what the loan amount is, right? It's just a basic framework, an explanation of the transaction, detailing the transaction. So let's look at that real quick. An example of that. So before we do that, I wanted to show you this statute. This is Chapter 58 of the North Carolina General Statutes, Article 26, related to real estate title insurance companies. And I'm going to just read you this language. It says, provided, however, that no such information shall be furnished, nor shall such insurance be so issued as to North Carolina real property unless and until the title insurance company has obtained the opinion of an attorney licensed to practice law in North Carolina and not an employee or agent of the company. Right? So I am a North Carolina licensed attorney, but I cannot certify title to Fidelity because I'm not independent of Fidelity. When I owned Barrister's Title, I was a lawyer, but I could not certify title to Barrister's Title because I was not independent of Barrister's Title. Right? So that requirement for independence comes from North Carolina statutes. All right, so here is an example of a commitment, and this is Schedule A of that commitment. So in this case, we have a transaction where Michael Holt is the buyer. He's paying $190,000 for this property. His lender is Watermark Capital. They're going to loan him $180,000. It tells us that the property is currently owned by Frederick and Catherine Briggs, and hopefully, although it's not always the case, the person the title is vested in is also our seller. And then it gives us a description of the property. In this case, it's all of 11 and part of 10 of Lot 10 in Oakmont in Guilford County, North Carolina. And then lastly, there's some information on here that we're giving the lender. They want us to give them their address and what's called a chain of title. You'll note that it says for informational purposes only here. That's because we're not ensuring that information. We are not ensuring that that is the correct address, and we are not ensuring that that is the proper deed that vested the title in Mr. and Mrs. Briggs. But they like for us to put this information on there so that they can verify it. So it ends up on our binders, even though it's not part of what's being insured. So I'm going to go back to our slides. So we looked at Schedule A. Now we're going to look at Schedule B. So this is Schedule B of the commitment. And Schedule B consists of two parts. There is a requirements section and an exceptions section. And remember, I said these are very literal terms, right? So the requirements section are things that we need in order to complete the order and issue a policy. And that if these requirements are not met, then we are under no obligation to issue the policy, right? So they are requirements. These things have to be met in order for us to be legally bound to issue the policy. The exceptions are what they sound like. They're exceptions of coverage. These are things that we are not going to insure over, right? They are exceptions and they will not be covered by the policy. Now, both of those sections of Schedule B, B1 and B2, have standard requirements and more specific requirements. Standard exceptions and more specific exceptions. And what I mean by standard is that we're probably going to see them in every commitment that we issue. right? So it's a requirement that we always put in our commitments, or it's an exception that we always put in our commitments. It's part of the template when we produce the policy or the commitment, we click on a template and it drops that information in there. Specific requirements and specific exceptions are things that we are picking up from the attorney's opinion. So if they tell us about a lien, or they tell us about a plat map, or they tell us about restrictive covenants, we're going to pick those up as either requirements or exceptions because they told us about it. So they're not standard, they're based on what the attorney is telling us in their opinion. So in Schedule B1, we have the requirements. Some examples of standard requirements are a deed from the seller to a buyer, right? If it's a purchase transaction, we will always have a requirement that there be a deed from the seller to the buyer. If there is a mortgage on the property, if the buyer is going to use a lender to purchase the property, we're always going to require a deed of trust. We always require lien affidavits. We always require the payment of taxes. If there are mortgages against the property currently, we always require that they be paid and canceled. Now, some examples of more specific requirements are equity line cancellations. So not every property has an equity line. Not everyone has a mortgage, but most people have mortgages. Not most people have equity lines. But if the attorney tells us there's an equity line, then we're going to require that it be canceled. If there's a judgment or a claim of lien, we're going to require that those matters be canceled of record. If the seller's in bankruptcy, we're going to require an order from the bank. The seller is deceased, we're going to require matters related to his or her estate. And if the seller's in foreclosure, we're going to require completion of the foreclosure. So those are very specific requirements that our experiences tell us we need to include whenever we see something that triggers us coming from the attorney's opinion. So Schedule B2 are the exceptions. Okay, so why do we take exceptions? Why do we not cover things? Well, we don't cover things that we know about. So it's similar to the health insurance industry. If they know that you have diabetes, then they're not going to cover you for diabetes, right? It's a pre-existing condition. They don't want to cover you for things they know they're going to have to pay out on. So it's the same sort of thing for us. If there's something of record that the parties know about, then we're going to accept to them. So some examples of standard exceptions are the gap exception, right? The gap exception is the period of time from when the attorney finished his search to the time when the closing occurs and the documents are recorded. So that could take a week, it could take a month, it could take 6 months. But if the attorney has stopped their search on April 1st and the deed gets recorded on June 1st, then there's a gap there where nobody has told us what's on the public records, and which conceivably could have something in there that's going to cause us a problem. Now, we remove that exception when and if the attorney tells us that they searched the gap and found nothing new, which they usually do with their final opinion. We accept to future property taxes, right? So we're in 2023. We will not pay for somebody's 2024 or 25 or 26 taxes, right? Those are things that they have to pay. They're exceptions of coverage. If there's a map on the property, then we're going to accept to anything that's shown on the map. If the attorney has told us about any easements or restrictions, then we're going to accept to them. We accept to mechanics liens unless and until the attorney gives us a proper form. We accept to survey coverage on owner's policies, and we either accept to what the survey is showing, if there is a survey, or what a reasonable survey would have shown if there is no survey. Right, so those are just examples of standard exceptions that we will see on a commitment. And then we have more specific exceptions, which again are based on the attorney's opinion. Those will come either in the opinion or oftentimes they're in the prior policy. So the policy may list a easement to Duke Power. If we see it on that policy, we're going to pick it up and put it in our policy. Some other examples of potential exceptions in an opinion on title would be railroad. The property is touching a railroad or an easement for a railroad, or there are leases that are impacting the property. And so we'll pick those up and require that either they be canceled or we're going to accept to them. So let's look at an example here of a commitment, Schedule B. And this is that same commitment we were looking at. Here is Schedule B1, the requirements. And you see right at the first one is a deed, right? So we're requiring a deed. We're going to require a deed of trust. And most of the first page, all of the first page, all of the second page, and into the third page are all standard stuff that is in most, if not all, of our commitments that we issue. And then we have specific requirements that are coming from the attorney's opinion. So the attorney told us there was a deed of trust, so we're going to require payment. The attorneys told us that there was a water bill that hadn't been paid, so we're going to require payment. Same thing with Schedule B2 with its your exceptions. We have our standard exceptions. Number 1 is the gap exception. Number 2 is the mechanics liens exception. Number 3 are the taxes exception. And then the more specific exceptions, which are coming from the attorney's opinion, are the plat book, the restrictive covenants, and the survey exception. So that's Schedule B. And that leaves us with the third part of the commitment, which is Schedule C. And Schedule C is really just a description of the property. So it has the description. In our case, we saw it on Schedule A. It doesn't have to go on Schedule A, although oftentimes we put it on Schedule A. Where it's supposed to go is Schedule C, which is the last page of the commitment. And it is the property that we're insuring. For leasehold policies, we can insure leases. When we're insuring a lease, we're not insuring the property, we're insuring the validity of the lease. And in that case, what goes on Schedule C is a description of the lease, not of the land itself. So next up are endorsements. Endorsements are additional coverages beyond the basic policy. And just like we saw with the requirements and the exceptions, we have standard endorsements that are issued almost every time, if not every time, and specific endorsements, which are dependent on the transaction or have been requested by one of the parties. In the residential context, right, and I want to stick with residential for the time being, there are two standard endorsements, the Alta 8.1 and the Alta 9.0. Those are two endorsements that we will see in any transaction where there is a lender. In fact, they are so requested that we just assume that any lender would want them, and they're part of the filed rates. So these two endorsements in the residential context are part of the invoice that we send to the customer, and it's part of filed rates. We have no discretion to charge what we want on these. They're part of the filed rates, and it's just part of the invoice that is built. Here's some examples of more specific endorsements. So if the property is in a planned unit, The lender may ask for a PUD endorsement. If the property is a condominium, we might be asked to issue a condo endorsement. Same thing if it's a mobile home, we may have to issue an Alta 7, which is the mobile home endorsement. If the loan has a variable rate, the lender may ask for a variable rate endorsement. In the residential context, we cannot charge for these, right? These are free. The 8.1 and the 9, we can charge for. Anything else in the residential context is basically given for free. Now, in the commercial context, it is very different. In the residential context, we almost always never talk about endorsements. If the property is a condo, somebody may ask for a condo endorsement. They ask for it, they get it. There's no negotiating. There's no discussion about it. It's fairly easy, and there's no cost associated with it. Not true in the commercial context. In the commercial context, it's not unusual to have 10 or 20 endorsements requested. And they tend to be very time consuming. The staff has to put together requirements related to those endorsements. Oftentimes, the lawyers to the transaction want to change the wording of the endorsement. They want to negotiate with us about the language. They want to fight with us about which ones are appropriate to use. And they want to fight with us about whatever fees that we want to assess. We typically like to charge for these things because they're time consuming. They're probably more time consuming than actually writing up the commitment. And we do have discretion, right? So Fidelity has a table where you can look and see what these things are generally charged for, or each of the offices might have their own schedule or their own way of handling these things, but they're negotiable. As a salesperson, if you were involved in a commercial transaction, you might be asked, whether there's some wiggle room on the pricing. And if you do get that question, I would recommend you talk to your manager and let them know that somebody's asked for a price break, and figure out between the two of you whether that's something you can accommodate or not. And these are some examples of the more popular endorsements that are issued in the commercial context. A same as survey endorsement is what it sounds like. We're saying that the property we're insuring in Schedule C is the same property that is shown on the survey. An access endorsement means that the property is touching a public right-of-way. Zoning endorsement means that the property is zoned a particular way, particularly in a way that the buyer intends to use it. And then the other ones cover various other things. And so each of these endorsements, and there are bunches of them, there are dozens and dozens of these things, are providing slightly additional more coverage than the basic policy. So let's look at a couple just for funsies. Here is the 8.1, right? Remember, this is the one that is issued as part of every residential closing, and it is part of the filed rates. And it's covering environmental liens. So it's coverage that the basic policy does not offer that's related to environmental liens. And then here's an example of the 9.0. There's another one that we see in the commercial context for the lender. I'm sorry, residential context for the lender. And it covers all sorts of things. It's called the comprehensive because it covers lots of things. And again, this is additional coverage that's not provided by the basic policy. So next up is the title policy itself. So we're going to talk about the owner's policy and lender's policy and what one looks like. And then we're going to talk about the policy jacket, which I'll explain what that is here in a bit. So here are the components of the policy, right? It has the effective date. It has the name of the person or entity that we're insuring. It has the vesting date, which is the date the deed into our insured was recorded. It tells us what the endorsements are to the policy and attaches the endorsements to the policy. And it lists exceptions from the policy. Now, you may notice there's something missing from the commitment, and that's the requirements, right? Because the requirements were the things that we needed to issue the policy. So once we issue the policy, those requirements are gone, and we would not have issued the policy unless we had proof that those requirements had been met. So let's look at one. Here's an example of a policy. This one is a loan policy, and we know that because you see where it says insured. The name of the insured is Watermark Capital. That was Michael Holt's lender, right? So we are issuing this policy to Watermark Capital. It's a lender's policy, and it's in the amount of their deed of trust, $180,000. And it tells us the effective date. So this is the date that the deed of trust would have been recorded, December 14th, 2017. It tells us the instrument that we're recording, which is their deed of trust. And it provides a description of the property. Chain of title is still there and is for informational purposes only. And then we go to Schedule B, and you can see Schedule B at the top here says exceptions from coverage. No requirements. The requirements are gone. That part of the commitment has just been stripped out, and what's left are the exceptions from coverage. So these are things that we are not going to be insuring. So in this case, we're not insuring future taxes. We're not insuring anything that shows on the plat. We're not insuring the restricted covenants. So I'll say it again because it's important. These are exceptions from coverage. So if these are the exceptions for coverage, you might be asking yourself, what tells us about what is covered? And if you ask yourself that question, the answer is the policy jacket. And so what is a policy jacket? Well, again, first off, it's a very literal term. What I just showed you, we refer to as the policy. The policy is folded up like into tries, and then wrapped around it is the policy jacket. So it's a jacket, right? It's covering up the policy. And it's the jacket that provides the coverages. Now, the jacket is a standard document. It is always the same. There is nothing changed. We couldn't change it if we wanted to. You literally just print it off. And it has in it the things that are covered by our policies. So it's basically the policy. What we produced were exceptions. So what we produce, which we call the policy, is really things that are stripped out of the coverage. So let's look at one. So here's an example of a jacket. This one is issued by First American, and it is a loan policy jacket. So this First American loan policy jacket will look the same for every single policy we produce, right? The only thing that's going to be different is it's going to have this policy number on it, which ties it to the policy that we issue. So right at the beginning, it tells us what the covered risks are, right? So this is what's telling us what the coverages are. And first sentence says, subject to the exclusions from coverage, which is in this document, and the exceptions contained in Schedule B, which is that document I just showed you, which is the policy that we create. So they're telling us, first sentence in the covered risks, we're going to cover the things that are shown below, less the exclusions from coverage, which is in this document, less the exceptions that are contained in this other document. So here are some things that the policy covers, and I don't want to get into all of them, but things like forgery and fraud, the title being vested in some other person, the failure of the proper person for an entity to execute a document, unmarketable title, lack of access. I mean, there's 4 on that page and then 14 total, right? So 14 different things that are covered by the policy. That's the basic policy. The endorsements would provide additional coverages. And then we have exclusions. So the policy is telling us we don't cover these things. So these are exclusions from coverage. These are things that are not covered by the policy. And then we saw in that very first sentence, other things not covered by the policy are those exceptions that we created when we issued the policy. Right. And then there's lots of other stuff in here. If you've ever looked at your auto insurance policy or your homeowner's insurance policy, there's all sorts of different paragraphs to tell you different things about the coverage and the limitations of liability. And same thing with our policies of insurance. There's the terms of the policy are covered in this jacket. And then we're going to talk about one more thing. It's a very curious document called the Insured Closing Protection Letter. We refer to it as the ICL or the CPL, and those are synonymous terms. It's just a preference on which one you use, whether you use ICL or CPL. And the closing protection letter is additional coverage for a very specific type of loss. What this document does is it protects the lender from an attorney's misconduct. And that misconduct can occur in one of two ways. Either because the attorney has failed to comply with the lender's instructions. So for every closing, the lender provides detailed instructions to the closing agent. And these things may be 30, 40, 50 pages long. And they tells the attorney all the things that they expect from the attorney. So if the attorney violates those instructions, the lender can file a claim on the CPL. And the other thing it does, probably more importantly, is it protects the lender from the attorney's dishonesty or fraud. So if they've stolen the lender's money, then the lender could file a claim on the CPL. Now, it used to be that we would provide this coverage for free, for zero, cost nothing. And the understanding was that we're willing to give this coverage for free because this is never going to happen. Attorneys are not going to steal from their trust account. They're not going to steal the lender's money. And then the Great Recession hit 2007, 2008, and there were a couple of really big losses in Charlotte. And I'm sure there were losses around the state, but I knew of the two in Charlotte because I live in Charlotte. Tom Brown was an attorney in Charlotte. Christine, you probably remember Tom Brown. He stole money from his trust account. When the Great Recession hit, those thefts became obvious as the balance in his trust account started to diminish. And it was roughly $2 million in losses. And Roger Cardinal was another attorney in Charlotte that had a similar thing happen, roughly $2 million in losses. So the insurers around the state are looking at $4 million in losses for something that didn't even charge for. And so they realized that if they were going to be on the hook for liability, then they might as well charge for it. And so now the CPL fee is part of the filed rates. So there is a fee. It's not a really big fee, but there is a fee associated with the issuance of this closing protection letter, which is for the benefit of the lender. Now, I've used that term, filed rates. Does anybody know what I mean when I say filed rates?
You mean with this, like the State Board of Department of Insurance?
Yeah, so basically when filed rates in North Carolina means that the Ratings Bureau got together and told the insurance commissioner what the rates are going to be. And you might ask yourself, wait a minute, how can the insurance companies tell the insurance company what they're going to charge? I mean, isn't that monopoly? Isn't that antitrust? They all get together and they tell the commissioner what they're going to charge. And the reason why it's okay is because there's a negotiation that goes on between the Ratings Bureau, which is made up of all the insurance companies in the state, and the Department of Insurance. Ultimately, they cannot charge what they want. They can only charge what the commissioner allows them to. So when they want to change the rates, when they want to charge more, they have to produce to the insurance commissioner some proof that shows why it makes sense for them to charge more. So it's a negotiation between the industry and the commissioner who's representing the people. And so when we talk about filed rates, what we mean are all of the insurance companies have gotten together, have negotiated with the commissioner of insurance to say that this is what we would like to charge. And since all of the insurance companies in the state are part of the Rating Bureau, that is why the prices are exactly the same. And that there is no discretion in changing what we charge to the insureds because we've already agreed to do it and the commissioner has said that that's what you can charge. So we don't have any leeway to go up or down. That is what's been agreed. So anybody have any questions? No questions? That's fine. Hold on, I'm just going back to my slides. Give me a second here. All right, so that is today's session, this month's session. Next month, we'll be meeting on August 24th. This will be the final session of SalesU. We had talked about this being an in-person session, similar to what we did in January, but due to budget constraints, we have decided to not meet in person, and we're going to just have one more Zoom call in August. And that call will concern commercial sales. So that's it. Thanks for your time, guys. I appreciate you. And as always, if you need anything from Summer or I, please feel free to let us know.
Thanks, Al. Thanks, Summer.
Thank you.
Thank you. Thank you. Thank you. Bye.
Bye.